In the span of a single trading session, two headlines crossed at once. Several banks announced temporary limits on withdrawals. At the same time, gold surged past $2,450 an ounce, pushing into territory few expected so soon. On their own, each event could be explained away. Banks sometimes tighten liquidity as a precaution. Gold sometimes rallies on geopolitical tension or inflation data. But when both happen together, the pattern becomes harder to ignore. Modern banking is built on one core promise: access. Your money is supposed to be available on demand, whether through an ATM, a wire transfer, or a digital payment. The system functions because depositors believe their funds are liquid. That belief is rarely questioned. It sits quietly in the background of daily life. So when a bank restricts withdrawals in limited format, disrupts that invisible contract, it introduces friction where none is expected. And friction in a liquidity system is not a minor detail. It is a signal. Now consider the second headline. Gold crossing $2,450 is not just another price move. Round numbers matter in markets because they reflect psychology. They act as thresholds. When gold clears a major level, it often means institutional capital is reallocating, not speculators chasing noise, but long-term money adjusting exposure. Gold is often described as a relic. It does not pay interest. It does not generate cash flow. In strong, stable financial environments, it tends to underperform risk assets. Yet, when uncertainty about the monetary system rises, gold becomes attractive precisely because it is outside that system. It is no one else's liability. This is where the contradiction becomes powerful. Banks represent trust in the financial architecture. Gold represents skepticism of it. When access to deposits tightens, while gold breaks out, the market appears to be expressing two opposing forces at once: institutional strain and defensive positioning. The important point is not to assume crisis. Liquidity management is part of banking. Gold rallies do not automatically mean collapse, but the coexistence of these two developments suggests stress at the margin. And systemic stress does not announce itself loudly at first. It shows up as small deviations from what we consider normal. Historically, financial disruptions often begin with subtle adjustments. A funding market tightens. A regional bank faces concentrated withdrawals. A central bank expands swap lines quietly. None of these actions, in isolation, signal failure. But together, they reveal pressure building beneath the surface. What makes this moment unusual is timing. Banks are supposed to be more regulated and more capitalized than in past decades. Digital monitoring of liquidity is constant. Risk models are sophisticated. And yet, withdrawal limits are appearing in the same window that investors are bidding up a 5,000-year-old monetary asset. That pairing raises a deeper question. What exactly is being priced in? Markets move not just on data, but on expectations. If depositors sense tighter credit ahead, they may shift savings behavior. If institutions anticipate currency, volatility, or policy shifts, they may increase hard asset exposure. These decisions are rarely emotional. They are often precautionary. In other words, this may not be panic. It may be preparation. Preparation for what? That is the real issue. Because when liquidity is questioned, even briefly, it forces a revaluation of assumptions. Is the stress isolated to a few balance sheets? Is it a function of higher interest rates pressuring bond portfolios? Or is it a sign that the cost of capital has finally exposed deeper mismatches in the system? Gold does not surge randomly. Banks do not restrict withdrawals casually. Both actions reflect incentives. Both respond to pressures. And both tend to surface when confidence shifts, even slightly. Confidence is difficult to measure. It does not appear on a balance sheet in bold print, but it governs everything in finance. Deposits remain stable because people believe they will remain stable. Currency retains purchasing power because people trust policy credibility. Gold stays dormant when faith in financial claims is strong. When that faith softens, even marginally, capital begins to reposition. So the real story here is not about a single bank policy or a single price level. It is about alignment. Two signals that rarely align are now moving together. That alignment demands analysis, not alarm, because if this is merely temporary noise, the system will absorb it quickly. Liquidity facilities will stabilize flows. Gold will consolidate. Headlines will fade. But if this is a structural signal, if trust in liquidity and trust in currency are both being reassessed, then we are not looking at a short-term headline. We are looking at the early stage of repricing. To understand which it is, we need to step back and examine what exactly has changed inside the financial plumbing. What rules are being bent, what assumptions are being tested, and why this moment, now. That is where the real investigation begins. To understand whether this is noise or something deeper, we have to look at the rules that normally govern the system. Modern banking operates on fractional reserves. Depositors place money into banks, and banks lend most of that money out. Only a fraction is kept as immediate reserves. This structure is not reckless by design. It is efficient. It allows credit to expand, businesses to grow, and households to finance homes and education. The system works because not everyone asks for their money back at the same time. But embedded in that efficiency is a structural mismatch. Banks borrow short and lend long. Deposits can leave tomorrow. Loans and bonds mature years from now. This is known as duration mismatch. Under normal conditions, it is manageable. Under stress, it becomes fragile. When interest rates rise quickly, the value of long-term bonds declines. Many banks hold government bonds as safe assets. They may be safe from default, but not from price volatility. If a bank is forced to sell those bonds to meet withdrawals, it can lock in losses. If withdrawals accelerate, liquidity tightens. The issue may not be insolvency. It may be timing. This is why withdrawal limits, even temporary ones, matter. They are rarely the first step. They are usually a response to fast-moving outflows. In 2008, liquidity froze between institutions. Banks hesitated to lend to one another because trust evaporated. During regional bank stress more recently, concentrated deposit bases moved quickly through digital transfers. Internationally, capital controls have appeared when currency pressure became overwhelming. These events share a pattern. Liquidity disappears faster than models predict. Confidence shifts faster than regulators expect. And once access is questioned, behavior changes. Digital banking has amplified this dynamic. Funds can move in seconds. A rumor can spread in minutes. The speed of money has increased, but the underlying structure of duration mismatch remains the same. That tension between speed and structure is one of the quiet vulnerabilities of modern finance. Now layer gold onto this framework. Gold breaking above $2,450 is not simply a chart milestone. Round numbers act as psychological markers for institutional allocators. Portfolio managers watch these levels because they signal momentum and confirm trends. When gold clears a major threshold, it often triggers systematic buying from funds that follow price signals. But beyond technicals, there is a structural dimension. Central banks have been steady buyers of gold for years. They do not announce purchases with fanfare. They accumulate gradually, diversifying reserves away from over-reliance on any single currency. When sovereign buyers increase allocations, it reflects strategic planning, not speculation. Gold tends to rise when real interest rates fall, or when inflation expectations rise. But it also rises when trust in monetary stability weakens. That weakness does not require crisis. It can emerge from rising debt levels, geopolitical fragmentation, or concerns about long-term purchasing power. The key shift here is that gold is advancing despite an environment that, on paper, should not fully support it. Rates remain elevated. The dollar has not collapsed, and yet capital is flowing into a non-yielding asset that suggests motivations beyond short-term inflation hedging. Gold does not surge because of a single headline. It moves when long-term holders adjust their view of risk. It reflects shifts in confidence that are often invisible in daily data releases. So when banks tighten withdrawals and gold breaks out at the same time, two foundational assumptions begin to look less absolute. First, the assumption that deposits are always frictionless. In reality, access can become conditional under stress. Second, the assumption that cash in the banking system is inherently safer than hard assets. If liquidity becomes uncertain, that hierarchy can reverse in perception. This does not mean the system is failing. It means the buffer between stability and strain is being tested. Financial systems rarely break because of a single shock. They adjust gradually as incentives change. Depositors move funds toward perceived safety. Banks respond by conserving liquidity. Central banks monitor funding markets. Sovereign institutions rebalance reserves. Each actor behaves rationally within their own framework. Yet collectively, these adjustments can signal a structural tremor. We are moving from isolated events to pattern recognition. If this is merely a temporary liquidity management episode, gold's breakout may stall and banks will normalize operations. But if the underlying cause is deeper, if duration pressures, debt loads, and geopolitical realignments are reshaping trust, then we are observing the early phase of repricing across the system. And that repricing does not occur only in financial markets. It extends into physical assets, trade relationships, and the balance of global power. To see that layer clearly, we need to look beyond balance sheets and into supply chains and sovereign leverage. To understand whether this repricing is temporary or structural, we have to step outside the banking system and look at something more concrete: physical leverage. Gold is not created in trading terminals. It is mined from the ground, refined, transported, vaulted, and stored. Its journey runs through specific jurisdictions, major mining regions in North America, Australia, Africa, and parts of Asia. From there, it moves to refining hubs, often concentrated in Switzerland and parts of East Asia. Finally, it settles in vaulting centers in financial capitals or in sovereign reserves. That chain matters. Unlike digital deposits, gold cannot be created with a keystroke. Its supply grows slowly, usually 1 to 2% per year. Production depends on energy costs, labor stability, environmental regulation, and geopolitical conditions. If energy prices rise, mining margins tighten. If shipping lanes are disrupted, delivery timelines stretch. If sanctions target key producers, supply flows adjust. In other words, gold is embedded in real-world infrastructure. The same is true for the broader commodity complex. Oil, natural gas, copper, rare earth elements. These are inputs that power industrial economies. Their extraction and transport rely on stable trade routes and political agreements. When supply chains fragment, pricing power shifts. This is where financial stress intersects with physical control. When banks face liquidity pressure, the immediate concern is access to deposits. But beneath that, a deeper layer exists. Sovereign states hold reserves not only in currencies, but in hard assets. Over the past decade, central banks have steadily increased gold holdings. This is not a reaction to a single event. It reflects long-term diversification. At the same time, geopolitical tensions have intensified. Sanctions have been used as economic tools. Payment systems have been restricted. Trade relationships have been reshaped. In response, many nations have sought to reduce reliance on any single currency settlement network. De-dollarization is often overstated in public debate. The dollar remains dominant in trade and reserves. But at the margin, incremental shifts matter. When bilateral trade agreements settle in local currencies, or when gold is used as collateral in cross-border transactions, the architecture of global finance adjusts slightly. Those slight adjustments accumulate. Gold flows have increasingly moved from Western vaults toward Eastern buyers. This shift does not happen loudly. It occurs through long-term contracts and steady accumulation. When sovereign institutions build reserves, they are not speculating on quarterly price targets. They are positioning for strategic resilience. In periods of financial calm, this positioning seems abstract. But when liquidity stress appears in the banking system, the value of hard assets becomes more visible. Control over physical commodities grants leverage. Nations that produce energy or critical minerals can negotiate from strength. Those that hold large gold reserves have optionality in currency volatility. During financial strain, leverage becomes more important than yield. This reframes the narrative. Retail withdrawal limits are visible symptoms. The deeper contest involves who controls real assets when financial claims are questioned. If confidence in paper assets softens, even slightly, demand for tangible stores of value rises. Not because the system collapses, but because hedging behavior intensifies. Supply chains amplify this effect. If shipping routes are vulnerable or energy costs spike, commodity prices respond. Higher input costs feed inflation pressures. Inflation pressures complicate central bank decisions, and tighter monetary policy can strain bank balance sheets further. The loop becomes circular. Financial stress increases interest in hard assets. Hard asset pricing influences inflation. Inflation shapes monetary policy. Monetary policy feeds back into banking stability. Each layer interacts with the others. This is why the current moment may represent more than isolated banking friction. It may reflect a broader rebalancing of power between financial claims and physical control. When trust in purely digital liquidity weakens, even marginally, the relative value of tangible reserves rises. Sovereigns understand this. Institutions understand this. Markets begin to price it. The story, then, is not simply about depositors seeking safety. It is about nations recalibrating resilience. It is about supply chains becoming strategic assets rather than background infrastructure. And when global power dynamics begin to shift around hard assets, the consequences extend directly into currency markets, bond yields, and the long-term purchasing power of money itself. When power begins to shift toward hard assets and sovereign positioning, the next pressure point is money itself. Currencies sit at the center of the modern financial system. They are the unit in which debt is issued, trade is settled, and savings are measured. When gold rises sharply while banks tighten liquidity, it forces a deeper question. What is happening to confidence in money? Central banks face a narrow path during periods of bank stress. If liquidity tightens and depositors grow uneasy, policymakers can inject support. That often means lowering rates, expanding lending facilities, or increasing balance sheets. These actions stabilize banks in the short term. But there is a trade-off. Lowering rates can weaken a currency. Expanding liquidity can fuel inflation expectations. If inflation is already elevated, easing policy risks undermining purchasing power. On the other hand, maintaining high rates to defend the currency can intensify pressure on bank balance sheets. Higher rates reduce the market value of bonds and increase funding costs. This is the dilemma. Defend the currency or defend the banking system. Bond markets reflect this tension in real time. Government bond yields move not only on inflation data, but on expectations of future policy. When yields fall sharply during stress, it often signals that investors expect rate cuts. When yields rise, it can signal concern about inflation or fiscal sustainability. Gold's behavior in this environment is revealing. Traditionally, gold performs best when real yields, nominal yields, adjusted for inflation decline. Lower real yields reduce the opportunity cost of holding a non-yielding asset. But when gold rises, even as nominal rates remain elevated, it suggests something more complex. It can imply that investors are less focused on short-term rate levels and more concerned about long-term currency stability. In other words, the issue shifts from inflation to trust. Trust that debt levels are sustainable. Trust that central banks can manage competing mandates. Trust that purchasing power will not erode gradually over time. The dollar remains the dominant global reserve currency. It is deeply embedded in trade, energy markets, and financial contracts. Yet dominance does not eliminate vulnerability. Persistent fiscal deficits, rising interest expenses, and expanding sovereign debt create structural pressures. These pressures do not cause immediate collapse. They operate slowly. But when combined with banking stress and geopolitical fragmentation, they can alter perception. Perception drives capital flows. If investors believe future policy will prioritize financial stability over currency strength, they may seek assets outside the traditional system. If they believe inflation will be tolerated to ease debt burdens, they may shift toward tangible stores of value. At the same time, hidden consequences ripple through the domestic economy. Banks facing liquidity strain often tighten lending standards. Credit becomes more selective. Small businesses find borrowing more expensive. Mortgage approvals slow. Commercial real estate refinancing becomes harder. None of this appears dramatic on the surface. But credit is the lifeblood of economic growth. Slower credit growth leads to slower expansion. Asset prices, especially those dependent on leverage, may reprice. Equity markets can remain resilient for a time, but beneath the surface, funding conditions shape long-term trajectories. Savings behavior also changes. Households may hold higher cash balances, seek higher yields in money market funds, or diversify into hard assets. Corporations may delay investment decisions, preserving liquidity until policy direction becomes clearer. These are not signs of panic. They are adjustments to uncertainty. The deeper issue is that currency confidence is rarely tested directly. It is tested indirectly through behavior, through how quickly money moves, through whether deposits remain stable, through whether sovereign buyers accumulate gold quietly in the background. When gold advances alongside banking friction and elevated debt levels, it can represent a quiet vote of caution, not a rejection of the system, but a hedge against its potential strain. This transforms the narrative from a short-term liquidity event into a broader examination of monetary credibility. If central banks intervene aggressively, currencies may weaken over time. If they maintain tight policy, growth may slow and financial stress could deepen. Either path reshapes incentives across the economy, and those shifting incentives eventually reach ordinary households and businesses, altering decisions about savings, investment, and risk in ways that are often misunderstood at first glance. When incentives begin to shift at the monetary level, the effects do not stay confined to bond desks or central bank meetings. They filter outward, slowly, into everyday financial life. Bank liquidity constraints are rarely visible in dramatic ways. More often, they show up as subtle tightening. A small business renewing a credit line may face higher rates or stricter terms. A commercial property owner may find refinancing more difficult. A first-time homebuyer may qualify for a smaller mortgage than expected. These are incremental adjustments. But credit availability shapes economic momentum. Small businesses, in particular, rely on steady access to working capital. If banks conserve liquidity, they lend more, selectively. That does not mean loans disappear. It means underwriting standards rise. Projects that seemed viable under abundant credit may no longer meet thresholds. Expansion plans slow. Hiring decisions become cautious. Regional economies can feel this pressure unevenly. Community banks often serve local industries: agriculture, construction, small manufacturing. If those banks tighten balance sheets, the impact is concentrated geographically. Economic slowdowns rarely spread evenly. They begin in pockets. Mortgage markets also reflect liquidity conditions. When funding costs rise or uncertainty increases, banks prefer shorter duration assets and stronger borrower profiles. That can cool housing activity even without a collapse in demand. Housing is sensitive not just to interest rates, but to lender confidence. Retirement accounts are influenced indirectly. Equity markets respond to earnings expectations, and earnings depend on credit availability. If lending slows, corporate growth may moderate. Bond allocations in retirement portfolios are also sensitive to rate volatility. Rising yields can create short-term losses, even in high-quality fixed income. These linkages are complex, but they can be understood through simple mental models. The first is liquidity versus solvency. Liquidity refers to access to cash in the short term. Solvency refers to whether assets exceed liabilities over time. A bank can be solvent, but illiquid if it holds strong long-term assets that cannot be quickly converted to cash without loss. Many financial disruptions begin as liquidity events, not solvency collapses. Understanding this distinction prevents overreaction. Temporary liquidity stress does not automatically imply systemic failure. But persistent liquidity problems can evolve into solvency concerns if forced asset sales erode capital. The second model is trust as financial oxygen. Trust allows deposits to remain stable. It allows lenders to extend credit confidently. It allows currencies to circulate without constant scrutiny. When trust is abundant, the system operates smoothly. When trust thins, even slightly, behavior changes. People move funds more quickly. Institutions hold more reserves. Credit standards rise. Trust cannot be legislated instantly. It is earned through consistent policy and transparent balance sheets, and it can weaken quietly before headlines acknowledge it. The third model is duration mismatch as hidden fragility. Banks and financial institutions often borrow short and lend long. This structure works under stable rate environments, but rapid shifts in rates expose mismatches. Long-term assets lose market value, while short-term funding costs adjust quickly. This dynamic does not always appear in simple metrics, yet it can create pressure beneath the surface. Recognizing duration mismatch helps explain why rising rates, intended to fight inflation, can strain financial institutions unexpectedly. The fourth model is hard assets versus financial claims. Financial claims deposits, bonds, equities depend on counterparties and systems. Hard assets, such as commodities or physical property, exist outside those claims. In stable environments, financial claims are efficient and productive. In uncertain environments, the appeal of tangible assets can increase. This does not imply that one category is superior in all conditions. It highlights that different assets respond differently to shifts in confidence and policy. These frameworks are not predictions, they are lenses. When headlines accelerate withdrawal limits, gold surges, rate speculation mental models provide stability. They allow viewers to interpret events through cause and effect rather than emotion. They separate structural issues from temporary noise. Most financial cycles unfold gradually. Credit expands, tightens, expands again. Asset prices adjust. Policies shift. The key is understanding where in that cycle the system may be operating. And as these pressures evolve, the range of possible outcomes widens. The next phase depends on how policymakers respond, how sovereign actors position themselves, and how markets interpret those signals over time. As we widen the lens, it becomes clear that the current moment does not point to one inevitable outcome. Financial systems are adaptive. They bend, they recalibrate, and sometimes they quietly reset. What matters now is not certainty, but probability. There are three broad paths that could unfold from here. The first is a contained liquidity event. In this scenario, regulators move quickly and decisively. Central banks provide targeted liquidity facilities. Banks access short-term funding without being forced to sell long-duration assets at losses. Depositor confidence stabilizes as access concerns fade. Withdrawal limits are lifted. Headlines cool. Under this path, gold's breakout may consolidate rather than accelerate. Prices could stabilize as systemic fear subsides and bond markets regain equilibrium. Credit conditions would tighten slightly but not dramatically. Economic growth would slow at the margin, yet remain intact. This outcome reflects resilience. It assumes that stress is localized and that policy tools remain effective. Historically, many liquidity events have been absorbed in this way. The system absorbs the shock, recalibrates risk models, and moves forward. The second path is slower and more subtle. A gradual credit contraction. In this scenario, there is no dramatic crisis. Instead, banks quietly tighten standards across the board. Lending growth slows quarter by quarter. Businesses scale back expansion plans. Consumers face higher borrowing costs and stricter approvals. Economic growth softens, not abruptly, but steadily. Asset prices adjust to lower credit availability. Corporate earnings face pressure from reduced leverage and cautious spending. Bond yields may decline as markets anticipate slower activity, yet risk premiums remain elevated. Gold, in this environment, could trend higher over time, not in explosive spikes, but as a steady allocation shift. If investors perceive that policy will err on the side of supporting banks and managing debt burdens, they may continue increasing exposure to tangible reserves. This path reflects prolonged adjustment. It does not involve collapse. It involves patience and repositioning. The third scenario is more structural. Here, sovereign demand for gold accelerates meaningfully, not as a symbolic gesture, but as a strategic move. Nations diversify reserves more aggressively. Bilateral trade agreements expand outside traditional currency channels. Confidence in long-term fiat purchasing power erodes incrementally. Central banks, facing rising debt costs and political pressure, may tolerate higher inflation to stabilize fiscal dynamics. Over time, real yields could remain suppressed relative to inflation. Under such conditions, gold becomes less a hedge and more a reserve anchor. Financial architecture would not disappear. It would adapt. Payment systems might fragment into regional blocks. Reserve compositions could diversify further. The dollar could remain dominant, but less singular. This scenario unfolds slowly. Structural currency shifts rarely occur overnight. They progress through phases: policy adjustments, reserve reallocations, incremental trade across all three paths. One principle remains consistent. Financial systems rarely break in a single dramatic moment. They evolve through feedback loops. Liquidity influences credit. Credit shapes growth. Growth affects fiscal balances. Fiscal balances influence currency confidence. The uncertainty lies in how these loops interact from here. If gold is signaling a quiet reassessment of trust, what happens if sovereign accumulation continues while banks restrict liquidity further? Does that reinforce stability by anchoring reserves in tangible assets? Or does it signal that institutions themselves are hedging against future volatility? The answer depends on balance sheets we cannot see fully in real time. It depends on policy decisions made under pressure. And it depends on whether confidence, once tested, rebuilds quickly or lingers in doubt. This is not a call for alarm. It is a recognition of transition. We are watching a system adjust to higher rates, higher debt, and shifting geopolitical alignments simultaneously. Each adjustment carries consequences that unfold gradually. In the next phase of this investigation, the focus turns to the core of the system: central bank balance sheets. Are current interventions expanding quietly beneath the surface? Are liquidity facilities masking deeper duration, stress? Or are policymakers genuinely ahead of the curve? To answer that, we need to examine the plumbing directly.